When it comes to investing, there's this one word that kind of runs the whole show: risk. And it's a word that gets a bad rap. It sounds scary, a lot of people try to avoid it, but today we're going to pull back the curtain and break down what risk really is. The goal? To help you stop fearing it and start, actually managing it. So let's kick things off with what is basically the one single non-negotiable law of the entire investing universe. It's actually super simple. If you want the chance to earn bigger rewards, you just have to be willing to accept more uncertainty. That's it. There really are no free lunches in finance.
And this trade-off, this one idea, is really the foundation for everything else we're about to get into. Once you really get a handle on this core principle, all the different ways risk shows up start to make a whole lot more sense.
I want you to think about it like a seesaw. You've got risk on one side and potential reward on the other. When one side goes up, the other tends to go up with it. But, and this is so important, notice that key word, potential. Taking on higher risk doesn't guarantee you a higher reward. It just opens up the possibility of one. Big difference. Okay, so let's get into our first category of risks. We're going to start with the big picture stuff. You can think of them like these giant financial weather systems that affect the entire investing landscape. These are the things that are pretty much out of any one person's control.
First up is market risk. This is the one you probably hear about on the news every single day, right? It's just the natural ups and downs of asset prices. It's that inherent choppiness of the financial ocean. This is the kind of risk that investors are always trying to manage by, not putting all their eggs in one basket.
Now, something that's really closely related, but definitely different, is economic risk. This isn't just about the daily swings in prices. No, this is about the overall health of the economy itself. We're talking about things like inflation quietly eating away at your purchasing power, or a full-blown recession that hits company profits pretty much everywhere.
So, what's the easiest way to keep these two straight? Think of it like this. Market risk is the symptom. It's those price charts going up and down. But economic risk? That's the underlying cause. It's the health of the whole economic engine that's making those charts move. You got to keep an eye on both.
All right, so moving on from those big external forces, let's talk about the risks that are kind of hiding in plain sight. These are the practical, really easy to overlook costs that can just silently eat away at your returns from the inside. Cost and tax risks? They're kind of like a slow leak in a tire. I mean, day to day, you might not even notice them. But over years, or even decades, things like management fees and the taxes you pay on your gains, wow, they can take a huge bite out of what you actually end up with.
And then there's this one, due diligence risk. To put it simply, this is just the risk of jumping into something without doing your homework first. It's the danger of investing based on a hot tip from a friend or some flashy headline without actually, reading the fine print.
Now, here's what's so important about this type of risk. You're in control. Yeah! Unlike those big economic storms, this is a risk you can absolutely manage yourself. By doing the research, really understanding what you're buying, and just refusing to invest blind, you're basically building a shield for your own portfolio.
Okay, we've talked about the outside world. We've talked about the hidden cost. But now we're getting to the final, and I would argue the most important category of risk. Because after you've done all the analysis, after you've checked the fees, you still have to face the final boss. And that boss is you.
So let's just ask the question. After you'd accounted for the markets, the economy, all the costs, what is the one thing that poses the single greatest threat to your long-term success as an investor?
And there it is. The answer is so simple, but so incredibly powerful. So often, the biggest risk doesn't come from Wall Street or Washington. It comes from the decisions we make inside our own heads, usually driven by two things: fear and greed.
And these are the classic traps we all fall into. Panic selling? That's when the market takes a dive and you sell everything at the absolute bottom, basically locking in your losses for good. And chasing hype? That's jumping on a bandwagon right as it's about to go off a cliff. See, both of these are emotional reactions, not strategic plans, and they can absolutely wreck your long-term returns.
So the big takeaway here is that risk isn't just one thing. It's actually a series of different layers. You've got the external risks you have to navigate, the hidden costs you have to manage, and finally, the internal emotions you have to master. Just understanding that these layers exist is the very first step to making smarter financial decisions.
And that kind of leaves us with one final thought. Look, you can never completely eliminate risk from investing. It's just part of the game. But by understanding where it comes from in all its different shapes and sizes, you can stop seeing it as something to be afraid of and start treating it like a variable you can actually manage. So the question for you is, are you ready to learn how?